You're watching Stockwatch. I'm Simon Brown, and joining me to unpack your stock-related questions today, Chantal Marx from FNB Wealth and Investments, Graeme Körner from Körner Perspective. Be sure to send your questions through via email, stockwatch@bdtv.co.za, SMS 41392. We're on X at Business Day TV using hashtag Stockwatch. Lady, gent, appreciate for joining us today. Chantal, let's start with you. Let's start with the email that arrived innocuously in my inbox at 8:15 from Standard Bank saying that Kenny Fekler was leaving. I thought he was going to be taking over from Sim Shabalala in a year or three. Turns out he's going to Absa. I mean, to me, I'm surprised, but and maybe he wasn't taking over from Sim. He had followed the path. But, I mean, your thoughts for Standard Bank, a loss, but I suppose they're going to say, we've got a deep team of smart people.
Yes, and that's exactly what they've said. We've got a deep team of smart people. We'll work on that succession plan. And I think that it was kind of expected that he would follow in Sim Chabalala's shoes. So they'll have to rework things there. I don't think it's a major catastrophe for them. I do, however, think it's a really big win for Absa. They've been struggling with management at the top, and yeah, they have a stable, proven hand that's stepping in with extensive experience both in the South African market as well as in the broader African space. And hopefully he will be the guy that actually ends up staying at Absa and rightening that ship.
Yeah, it's the staying part. Graeme, Absa was your stock pick a week ago. Does this make you smile? I mean, to Chantal's point, I think it's a good appointment. We've had a lot of CEOs since Miramis left in, 2018?
Yeah, pretty much so, Simon. I think it's great news. I think Absa, for me, is an incredibly well-placed business for good execution. I think they've been doing a good job in a very difficult environment. You know, when you can't have CEOs coming and going as frequently as they do, and think you're going to sort of really hit your rhythm from a strategy point of view. So I'm really pleased. I'm pleased for Absa. I'm sad for Standard Bank, but I think Standard Bank has, as Chantal was saying, they've got deep pool of talent. And I just hope that it's not like Daniel Manele again, where you get a great appointment and then it just, somewhere strategy with the board and the CEO just doesn't work. But I think he's incredibly highly regarded. I think he was very much heir apparent, given the changes that we saw. It was about a year ago that I think he became deputy CEO and CEO of SA. So I think it's a blow to Standard Bank, but I'm really pleased for Absa, because I think if he can come in and steady that ship and spend 5 or 7 years there, I think it'll be transformative for Absa, who, as I say, I think has got a really good foundation.
Yeah, and the other thing that surprised me was only 3 months of garden leave. I would have figured more for a CEO, well, for that senior, but nonetheless. Graeme, Sun International results out. We had the trading update. We knew it was coming well. And your take on Sun International, particularly with contrasting to City Lodge, which is really, and I appreciate the massive rights issue during the pandemic and everything else. They've brought food and beverage more into the business. Sun International is certainly doing a lot better, though, than City Lodge over the last little while.
Yeah, well, Simon, I think maybe looking at it slightly differently. If I'm not mistaken, the HEPs were probably up by a similar order, but granted, the base pretty low in City Lodge. But respectfully, very different businesses. If you look through the highlights of Sun International, they just talk about gambling and online betting, for example, whereas City Lodge is very much a hotel group. So Sun International has, I think, some really good assets. Obviously, Sun City has been making a contribution in the last while. But my sense is that very different businesses. But having said all of that, I think Sun International, sitting on a PE of, let's call it 9, growing your profits at 12%, seems to be some track, given the fact that the online betting revenues, I think they were up 60%. So they're talking about omni-channel, So I think it looks really well placed. Also, if you look at it from a dividend yield, also is really, really great. So you're being compensated. So I think right now, I think your point is well made that Sun International's got the wind at their backs. But I like the City Lodge story. I think that it's not a case of you have to pick one or the other. I think they're quite different businesses. So I think Sun International definitely trading very well. I think there's some optionality there, but I think that there's a lot of good news still to come from City Lodge. But it's a slower, more sort of dependable business model, whereas I think Sun International tends to be more of a beneficiary when spend comes through and maybe pick up in online gambling.
Yeah, Chantal, it is. I mean, the gambling and certainly the online's been huge. Your take on between the two of them, either, neither, both?
Yes, I mean, I really like City Lodge from a longer term perspective. I think it's just a lot easier to you've got much better earnings visibility from that company. And I do actually see a very positive long term trajectory for the business, particularly given some of the shifts that they've made in their strategy more recently to become more attractive to leisure travelers. Sun International, I actually also like, because it will benefit from an increase in domestic and international travel. It's already been a beneficiary. And the online gambling story is actually really exciting from a growth perspective. It's still in its infancy, but the players with a lot of money behind them and are able to have been able to scale quite quickly. They're actually turning a profit in that business. And I think the winners, the early winners will end up being the winners in online gambling, and Sun International is one of them.
Take your point on that. Question coming through around Tiger Brands. Is it worth looking at? The new CEO certainly seems to be doing a good job at the business. Chantal, Tiger Brands, for a long time they were struggling, but it does seem like they may be finding some mojo.
Yes, so the new CEO is a proper operator, and he's been in the business for a very long time. And I do think that the strategy to really simplify that portfolio and focus on kind of profitable business lines, divest from some of the really unnecessary businesses within that stable is the right strategy to follow. Whether or not that is going to translate into near-term growth, I think remains to be seen. But I think certainly longer term, the portfolio repositioning is putting it on the right path for growth. Importantly, Tiger Brands, just like all other food producers in South Africa, require a positive macroeconomic backdrop to really see that base evolve. And we will require a step change in economic growth to drive higher employment and proper kind of growth in our middle income cohort in order for them to see some really exciting growth longer term.
Yeah, it does. They need an economy. Graeme, Tiger Brands for you?
You know, Simon, we've spoken many times, and I said it was kind of my poster child of what I didn't like. I think they're positioning themselves, as Chantal was saying, well for the future. But the reality is, if you look at the Pick and Pays and the Shoprites, very much the strategy there, I think, to lower the basket cost, drive margins, and make baskets more affordable generally, I think is very much a white label thing. And that obviously is not great news, because Tiger Brands has spent a century building Koo and All Gold and a whole lot of other and Fatties and Monies brands. And I think it's going to be difficult to claw or to convince people to pay a premium for those brands. So I think they're doing better. I like the energy from management. I like the simplification of the portfolio. But if I look at it, I think we're probably looking realistically, Simon, at maybe 5% revenue growth. If they're lucky, 10% earnings growth. We'll see maybe the dividends do a little bit better than that. But the reality is you're paying a 14 multiple for 10% earnings growth. I think you can get a lot of companies where you're going to get better than earnings growth with much lower multiples. So it looks better, but is it a compelling story for me on the promise of the turnaround? I think it's too early. I'd probably rather, if I see nice weakness in Shoprite, I'd rather buy them because they win both ways.
I want to talk more about Shoprite in a bit, but before we get to that, Thungela, Graeme, results out. We pretty much saw it coming. We had the trading update. Revenues are up, but of course, lots else is struggling. None the least is logistics in South Africa. The dividend certainly surprised me, and I think it surprised the market. I don't know, single commodity stocks, they really got to be booming commodities. Your take on Thungela and the results and where it sits now with coal under some pressure?
Yeah, well, I think, coal is the dirty fossil fuel that a lot of people don't want. If I remember correctly, profits down about 30%. When you're on a 3 PE, you can probably tolerate that. Dividend yield, as you say, is really great. So I think the question is, what is the long-term prospects for this business? Obviously, locally, Transnet and others have caused some chaos. They have made acquisitions in Australia to try and offset that. But I think out of the single commodity cluster, I would argue that coal is necessary. As we know, when the lights go out, we need good quality coal. So and we're no different to many other parts of the world. But the reality of it is, I think that it's really cheap, and you could probably over 2 or 3 years have a dividend yield where you almost say, well, I could be sitting with almost a free position. But the long-term prognosis for me is not great. Dying industry. And my question is always, who are you going to sell these coal assets to? Because there are a lot of guys who, from an ESG point of view, have sort of labeled that as a no-go zone. So that's kind of the other problem. That you can buy something, that's got to sell it to somebody, and I think 5 years from now, that cohort will be quite small. People who would consider it, acceptable to hold an asset like that.
Yeah, sure. Chantal, Thungela, coal is an asset class?
Yeah, I mean, you are buying a company with a declining addressable market over time, and that is something that you need to be quite comfortable with. So there'll be times where there'll be energy pressure, and you will see the coal price spike. Perhaps take that as an opportunity to exit if you are invested in Thungela. For the time being, if you are invested for Thungela, enjoy your 11% dividend yield and your 1.5% sweetener in the form of share buybacks. I think as an income-generating asset, it makes a lot of sense. As a long-term holding, it doesn't really have legs for me. What I would just like to add as well, I mean, we've had Exxaro coming out with the announcement of their new CEO, who said that he is committed to driving a diversification strategy. So there is another major coal player saying, we can't really be here and only longer term. And Thungela will have to follow suit eventually.
Yeah, no, it's a fair point. When your competitors are getting out, that does perhaps tell you something. A question came through in the emails. After a good day for Renergen, should one buy? Chantal, of course, they finally, 2 years, 3 years, 5 years late, got some helium to market. To credit to Stefan and Moran and his team, they got the helium to market, albeit late. Would you be a buyer at Renergen at what's now around 8.50?
Yeah, so 7 years late, Simon.
7.
They were meant to deliver in 2018. Based on the asset and their forecasts, or the assets and what they say about the assets and their forecast, absolutely, there's still value in the company. But this is the first helium delivery. It's the first sale. That's great. At least it puts us further in terms of the realizing value from that Tetra 4 asset than we were a few weeks ago, well, a couple of days ago, really. But now they need to actually start scaling up. Now they need to deliver on scale. And they've had to fill smaller containers because the large container that they wanted to use, they were unable to actually successfully cool down to the temperature that they required it to be cooled down to. So I think that there's still some question marks that we need answering from management in terms of how are we going to scale this properly. And we probably need new forecasts from them, because a few years ago, they were aggressively marketing, giving us forecasts on possible sales volumes and production numbers that I do think are now a little bit outdated. But I think there's value, but I'm still a little bit skeptical.
Yeah, and I remember one of the forecasts was phase 2 by 2026, and I remember it was sales to Afrox that was supposed to kick off in 2018. Graeme, Renergen, it's a junior exploration miner. They've got production. It is always going to be risky and rocky is my key lesson.
Yeah, I think that's right. And I mean, I think Chantal's got a far better handle on it than I have. I've sort of watched it from the sidelines. I had a fairly good look at it a little while ago for a client who just asked about it. And I said, look, I mean, if the forecasts and the promises to be realized, then this is a fantastic dripping roast. So if you're in the, I'm happy to lose my money, but I want a 10-bagger, then this is the kind of thing that could, tick that box. But I think given the history of disappointment, and I think as Chantal was saying, now you go, into a production phase. Now I think it becomes quite capital intensive. So my sense is it really is one of those very binary options. You could do supremely well, or it can just fizzle. You just have to look at the chart over the last few years. So I don't really have a strong enough view. I'm not afraid of smaller caps and companies that are unloved, but I think you need to recognize that the business model on this one, it probably is a 5-bagger or next. I think that's my conclusion, because I don't think they'll be able to carry on disappointing and and gears slipping for another 3 or 5 years.
Yeah, it's the go big or go home. A question from him, and he's actually posing it to me, but I'm going to pose it to you as well. He asks if I bought Shoprite in the IPO. I didn't, although it was only 86. I thought the IPO might have been earlier. His question is, what makes you hold it? I first bought Shoprite about 20 odd years ago. I like the margins. Really, he's saying, what do you do when the stock you like isn't doing as well as perhaps it has been or will do? Chantal, it is tricky. You've got a good company, they go through tough phases. I mean, Shoprite over the last 20 years has mostly been doing quite well. But I mean, do you bail? Do you trust management? Or is it, I suppose, situation specific, each company on its own merit?
Yeah, absolutely. Each company on its own merit. If you are buying a company for the long term, then you need to kind of periodically review whether or not you still want to be invested in that company, right? So if the stock has done very well for you, and then it's very natural, I think, to feel, well, should I sell it now? Is there maybe a better opportunity out there? And then you need to go back to basics. So you need to think about why you bought the company in the first place. Was it because you thought it was cheaply valued? Was it because you really believed in the growth prospects? Was it because you really liked the management team? And then check if any of those fundamental things changed over the years. Let's say the stock re-rated and it now looks expensive, but it's still ticking the boxes in terms of growth and the strength of the management team. Then you need to ask yourself, well, perhaps we're just a little bit late in terms of kind of factoring in the growth that's yet to come. Analysts are maybe a little bit too negative, and they should be a lot more positive. So you need to just go back to basics, go back to first principles, and reevaluate if the original investment case still stands, and perhaps look for other opportunities in the stock that you might not have thought about 5, 10, 15, or 20 years ago. In your case, Simon.
I was going to say I'm not that old. I am that old. So I'd take similar. I have 3 points, and I remember my Shoprite ones. They were superior margins to competitors. They were innovation, which back then was distribution centers, not 60-60, and market share gains. And I keep on going back to that, and they keep on doing it. And yes, it's valuation, and yes, it's management. But I always have my couple of points that I really, really like, and do they stick with it? Graeme, holding long-term can be hard because markets don't go up in a nice straight line.
Simon, what I would say with Shoprite particularly, and I think I agree with everything that both of you are saying, and maybe 1 or 20 years ago when we were also buying it, 1 or 2 other things, private labels, I think was a big one.
Yeah.
The problem for me with Shoprite is not around management or execution. The problem is the market gets incredibly excited when they start doing well, and they push them to 30 multiples, and then you know, all of us on the call know, then over time it spends, they carry on delivering, but they kind of got to grow into the, that excessive rating. So for me, the problem with Shoprite specifically doesn't sit with the company and their execution or any of their strategies. They've executed brilliantly. The problem sits with the market. It gets ahead of itself. So for me, a company like Shoprite, if you sort of say, well, my strategy is to be exposed to it more often than not, but if it's going to go into a phase of significant underperformance, you just have to look from 2018.
Yeah.
It took you probably 5 years to break even again. Nothing again to do with the execution of the business, all to do with the valuation. So if you're saying, look, I don't want to be in an underperforming asset for 3 or 5 years, then a company like Shoprite, you'd say, truthfully, as brilliant as it is, they cannot grow their profits at 30 or 35% to unravel 30 PE. Am I making sense? So I would say, if you're the kind of investor who says, yes, I want to be fundamentally exposed to good businesses, but I don't want to be in something that's just drifting sideways or down over a 3 or a 5 year period, then you've got to be sober in your assessment and say, you know what, when a great company gets to a 2 times PEG, for example, you have to recognize that it's probably going to have an underperforming cycle. If you're not prepared to deal with that, you'd say, I'd rather on a 3-year view recycle that into something different. Maybe you want to sell it and buy Pick and Pay, for example, then that's your call. I've probably, like you, held this thing for a very long time. I think our average in price for some clients was probably $8.50. So, you then sort of take the view, well, I don't care if it's going to go down a little bit. But I think, as I say, I think Chantal's point is well made. It's company specific, but you need to recognize that there are some companies that the market gets very excited about and then sort of gets, as reality sets in, it drifts lower. And I would argue Shoprite is very much one of those.
Yeah, they had 2018, and as you say, easy 5 years, which included a pandemic, but before you were back at those levels. Graeme, we had MTN results out today. We have sight because we get to the underlying Nigeria and the other results coming through in the weeks ahead. I don't like telcos. Your take on MTN in particular and on the back of the results?
I also don't like telcos. Yeah, I think the market liked the divvy. Obviously, a lot of noise in these financials. So between impairments on Sudan and currency translation, I think it was about 30 billion rand. It tends to mess your financial statements up a little bit for, in the old days, they used to say you get damn lies and statistics. I'd say you've got after statistics, you've got modern accounting regulations. So I think the core operation, particularly obviously Nigeria, where they got the rate review, I think that's helping. But if you look at it, the reason I don't like it, you look at South Africa, which generates it's a quarter of revenue and about a third of profit. It was growing. I think whether it's services or data, it's like 3%. So I think it's a very full market. But yeah, clearly the market, if you look through all those accounting anomalies, the market was quite chuffed, and I think particularly around the dividend, and that's why it's up to probably about 2.5% today. But I really battled to get excited about any of the telcos in South Africa.
Chantal, do you like telcos?
No.
Oh, we're a sad bunch.
No, but I don't mind them, particularly when they're cheap. So I do think that MTN is cheaply valued. I do think that Vodacom is cheaply valued at the moment. As a long-term investment holding, it really doesn't make a lot of sense. MTN in particular, just so exposed to currency risk in the rest of Africa. But I think that this set of results showed us that operational momentum is quite positive, which is something to feel quite good about. Cash generation is also quite decent, and I think that it can improve over the next few years. One of the things that excites me about MTN is in the Nigeria business. So you do have the price increase that's been approved. They're not going to push through the 50% price increase all in one go. They're going to be very measured about that approach. So that should give you a little bit of top line support over the next, a lot of top line support over the next year, 2 or 3. And then the cost base they've worked really hard at. A lot of their tower leases were exposed to the US dollar. That has been renegotiated to take into account kind of the US dollar movement relative to the Naira. And that's going to really help their cost base. So I think profitability can improve quite meaningfully in Nigeria, and that should provide a meaningful uplift for the group as a whole. I'm also still quite excited about their fintech business. I think that there's still value there. There's a possibility that they can one day unbundle that. I don't know when that one day is, but I think that could be value enhancing. But yeah, I mean, it's not my fave, but I think it's on a decent footing right now.
Okay, and I take your point. It's not a long-term core portfolio. Looking at the 10-year chart, most definitely not. Let's go to stock picks. Chantal, Remgro.
Yes, so Remgro is that classic play on SA Inc. because it's got a little bit of everything in there, but it's trading at a 48% discount to its net asset value. Now, if you look at some of the companies in there where we've seen results so far, Outsurance, excellent results.
Yeah.
FirstRand, excellent results. Discovery, fantastic results. RCL and Rainbow Chickens performing very well. We don't have line of sight on Mediclinic, but I think that they would have just bumbled along. And then you've got Heineken saying that the South African business has really showed a turnaround over the last few months. So I think Heineken SA can stem some of the losses that we've seen over the last few years. So I think decent portfolio momentum for Remgro right now. Perhaps the question mark still around CIVH and the Vodacom tie-up. Hopefully we get good news on that soon. But it shouldn't be trading at a 48% discount to its net asset value. There are options there.
Yeah, I hadn't realized it was at 48. I remember the days when 16% was a big discount. Graeme, Ethos Capital Partners, we chatted on it last week. Stock pick today.
Yeah, I suppose Chantal and I are both in the discount to NAV play. I think what I like about Ethos is firstly, I mean, Chantal was rightly talking about fintech and the opportunity there. Ethos's biggest holding, representing about 50% of NAV, is a company called Optasia, which provides a lot of the technology for the likes of MTN and Vodacom, and around 500 million underlying users. But Simon, the board has resolved to basically liquidate as sensibly as possible the portfolio. So if you've got a R7.85 NAV, you're trading at R4.64 with, I believe, quite a bit of mojo in that NAV. I think there's a reasonable chance that can give you 10 or 15% NAV growth over the next while. And pretty much over the next 3 years, let's call it, they're going to return that to shareholders, either through specials or through buybacks or through distribution. So I believe there's a 40% discount to, let's call it, December's NAV. I think that NAV is going to strengthen, to June and to June of next year. So for me, you're buying a fairly compelling underlying portfolio at a discount with high visibility on the fact that that portfolio will be rationalized. Does that make sense? So I think I'm comfortable that the strategy to return capital will be executed, and that you've really just got like a 2 or 3 year horizon to take R4.64 to R7.85 plus, probably closer to R9 in terms of when all the dust is settled. So yeah, discount, but not just the discount, some exciting assets as well.
Okay, but 2 holdcos in today's show. That's it for Stockwatch today. Thanks to our guests, Chantal Marx, FNB Wealth and Investments, going with Remgro, Graeme Körner from Körner Perspective, going with Ethos Capital Partners. Up next at the close, stay watching.